stablecoins are the end game here. Instead of just dealing with the periphery of other countries where we're maybe just talking to their central bank or just talking to their major trading houses, this is how you get like the average person in a foreign country using dollars instead of their local currency. It gives the dollar another 50 years to run as many deficits as we want.
Greg Di Prisco is the co-founder of M0, a platform that lets companies issue their own yield-enabled stablecoins. Greg breaks down how stablecoins challenge banks, how M0 routes collateral across tokenized treasuries, and why he thinks stablecoins are becoming the digital cash layer of the internet.
What's something that you've said recently about stablecoins that someone was like, I don't agree with you on that?
That is kind of the alarming thing about where we are in the cycle. Something I'm nervous about is how friendly the media is towards this sector. Like every other sector of crypto, they hate it. They hate Polymarket, they hate Kalshi, they hate any sort of new crypto development that's happening. They think it's all a scam, but stablecoins, they love it.
Why do you think they love it?
I've always felt like you kind of need the media to be against you. Otherwise, you're doing something wrong.
Today's guest is Greg Di Prisco, the co-founder of M0, and he is a guest on our latest Talking Tokenization episode, where, of course, we're going to talk a bit about tokenization, but we're probably going to talk a lot more about stablecoins. So, Greg, I am very excited to sit down with you. Thanks for coming on. Yeah. Starting off, since this is the Talking Tokenization episode, we've got to ask, how do you define tokenization today?
Yeah, I know. And I preceded this by saying I hate this question because
I'm sorry.
Spoiler, I don't know if tokenization is an actual thing.
Oh.
I mean, it's a word that we use.
Yeah.
But generally, from my perspective, it's when you put something on a blockchain. Does it even need to be a blockchain? I don't know. I guess it's just digitization, which we've had for a long time. I guess so. If I'm going to give one definition, tokenization is a digitized asset where we've removed the barrier of being on different databases. So now if you have an asset on one database, like let's say a bank deposit, technically you can call that a tokenized dollar, but it can't really leave that bank without a centralized clearing mechanism. I would say tokenization is when you use a decentralized clearing mechanism to rectify the back end.
Okay, you're off the hot seat now.
Okay.
Back to M0. What made you decide to start this company, and what were you doing before?
So I've been working in stablecoins for quite a long time now. I was on the MakerDAO team very early on. I joined in 2016, early 2017. And yes, I've basically been working on stablecoins for almost 10 years. I wanted to build M0 because myself and Luke, and my co-founder, we realized that the fintech revolution, as we saw it, at least at the beginning with this whole crypto thing coming in, it wasn't playing out the way that we originally thought. The original vision, and this kind of bled into what Maker would become, we thought that everybody would be their own bank, right? We thought people were going to have bare assets. They were going to be able to print their own money. We were going to completely disintermediate the financial system. I think that vision was maybe 50 or 60 years too early. So we decided, what's really the next step here? And if you look at the credit side of the equation, what's been happening in the banking sector since the financial crisis, you've been seeing credit leave bank balance sheets. Like they're just kind of the wholesale facilitator of it. And you have these now shadow banks that have popped up, and they're essentially originating all the credit in the economy. They're underwriting. But the deposit side has stayed very strongly with banks. Mm-hmm. And that's actually inhibited a lot of fintech development. All of the fintechs from the first generation, like 2010 to 2020, they died because they were so dependent on their banking partners who didn't have the technology to keep up with them. Mm-hmm. So we kind of see stablecoins as a way to actually deliver that technology to the fintech market, where you can use a stablecoin, especially now post-Genius Act, as a replacement for a bank deposit in your user flows.
Yeah. That was going to be my question, is do you see it replacing ultimately bank deposits then?
I think so. I mean, there's always going to be a place for bank deposits because that's, again, where the credit origination lives. But I do think that they're going to pop up in increasing quantity, especially maybe taking more from the money market mutual fund arena, more so than from the direct banks. But banks are going to have to compete, right? I think that's the real benefit of this whole industry, is that banks are now in a position where they can't just say, all right, we have these captive deposits because of our government monopoly. We don't have to compete. We'll just pay these people nothing and lend it out at 7%. Mm-hmm. Now they're going to have to pay those people on the deposits, or they're going to lose the deposits to people that are building stablecoins.
Yeah. Do the banks kind of agree with you now, or they think you're crazy?
I mean, I don't know if they ever thought we were crazy. I think they thought that crypto was too weak to ever present a real challenge to them, and it was too outside of their sphere of influence. I think stablecoins have really changed that, especially now that Genius has passed. Genius gives you a very clear, regulated path to issuing these things in the US.
Yeah. You think without Genius, though, it would have been a lot more difficult for you guys to accomplish this?
Oh, yeah. I mean,
in the previous universe that we existed in?
It would have remained almost entirely offshore. Because onshore, you could still have the circles of the world that were going to build out their business. You were never going to get these big corporations that were comfortable to integrate because they couldn't appease their regulator. Now they can appease their regulator.
Yeah. And so M0 allows people to create app-specific stablecoin platforms? Or no, you guys are the platform?
Stablecoins, actually. We let them create their own branded stablecoin on our network. Underneath the hood, we connect them to a variety of issuers based on their needs. We're really a tech middle layer for the whole process.
Okay.
So just to walk you through what it might look like as a customer, you have a brand, maybe you're a fintech company in the US, you want to have a stable coin that you can put user funds into. What you'll do is you'll come to us. We will set up all the technology for you. We'll give you the endpoints. We'll make sure the smart contracts are functional and meeting your custom requirements. And then we'll hook you up to one of the issuers in the M0 network.
Yeah.
And once we've done that, you're up and running. Everything flows through the systems, and the users really have no idea what's going on. They're looking at it like they have a dollar balance in an app, but everything behind the scenes is now powered by stable coins instead of your banking partner.
Okay. Who are some of the clients today? Do we get to know?
Yeah, no, they're all public. I mean,
I looked at your website, but I didn't know if there was any other ones that are like, not being shown.
Yeah, so our largest client is a company called USDAI. Mm-hmm. They have, I believe, something like $600 million under the platform. Mm-hmm. And what they do is they finance GPUs for AI data centers. So they take in money, they leave it in their stablecoin USDAI, which is backed by our systems. And that just earns the company a T-bill yield. Basically, they use it as a safe way to store deposits while there's a mismatch of outgoing and incoming funds. And then they lend out a portion of the assets to data centers that are building out GPU farms. Mm-hmm. And our other one that you might know is MetaMask.
Yeah, I've heard of MetaMask,
They build MetaMask, a stablecoin. That one we partnered with Bridge, who's the issuer of record there. But they use all of our smart contracts, and they have a custom feature set that we built them on top of MU. They call it MUSD.
Okay, that's interesting. Where are you seeing kind of the most demand then from these builders that are creating these like application-specific stable coins and stuff?
It's really very much all over the place because they're as useful as dollars are useful to anybody. Anyone who has dollar flows going through their application is at least going to explore if their own stablecoin makes sense. And the reason you would do it is because you want to collect the yield that those deposits generate. If you use a banking partner, the bank gets all the yield. If you go to Circle or Tether gets all the yield. If you work with somebody like us, then we find a way to route you back the yield. Now, that yield doesn't necessarily go to your customers. That's going to be a jurisdictional regulatory question whether you can do that. Mm-hmm. But at the very least, we can often pass it back to the partner.
What do you mean by the yield aspect? Because I know when I stake like my USDC or something, I get yield. You're saying there's more than that.
So when you stake your USDC, you're really lending it. You're lending it to somebody else that's collateralizing that loan, maybe with Bitcoin, maybe with ETH, and you're taking on probably substantial risk to do that. These stable coins, especially the ones that are issued through our network, they're all backed by T-bills and basically cash equivalents. Mm-hmm. They're very safe. All of those assets still generate a considerable yield. I mean, the Fed still has the risk-free rate over 3%, which is nice. And we can basically collect all of that and pass it back to the partner that integrates with us.
Does M0 have a stablecoin?
No, we are just the tech. I mean,
you guys don't want to create one for yourselves?
It's actually a complicated question because we do have some assets that are used just for liquidity provisioning, but they're very much under the hood back-end assets. Mm-hmm. We really build everything for the customers. So a customer, they come to us, they want a branded asset. We don't try to compete with them in the market. We don't want to cannibalize that business.
Yeah. I mean, you don't have to compete. It's just for, money coming in. You guys could keep it. No. You're like, no, pass.
No.
All right. You guys stick to what you know. Yeah.
I wouldn't even know how to do it. We're tech.
Yeah. I guess on the front of stablecoins, obviously, they're like a very hot topic. I was joking that when I was in Dev Connect, I did 3 panels all on stablecoins, one of which was with Luca, your co-founder. And they were all...
A real Italian, by the way.
Yeah, he is a real Italian. He has the accent and everything. But obviously everyone wants to talk about stablecoins today, and I don't want to like beat a dead horse. So on the topic of stablecoins, where do you see the biggest shift right now, maybe in the traditional markets? And then I have some other follow-ups on that.
I think the biggest shift is the one that I was kind of insinuating earlier, which is that you're seeing fintechs who traditionally have had to build around banking partners starting to build around stablecoins instead of banks. It's completely extricating the banking sector from this vertical. And what that's doing, though, is giving them the ability to innovate in a way they couldn't innovate before.
Mm-hmm. And so these are traditional fintechs that are not just crypto native types of firms, or is it a mix of both?
It's both. And that's where I think M0 really serves both sides of the aisle. Mm-hmm. So on one hand, we have what we call our self-serve product. This is where like a fresh developer that's very crypto native and understands the market can come in and exclusively using code launch a stablecoin on our platform. Mm-hmm. They just need to go through a process to turn on the yield, but otherwise everything is completely permissionless. And then on the other side of our business, we have what we call the white glove service, where this is where we kind of handhold larger fintech companies or even larger crypto companies like Consensus and MetaMask into their issuance process.
Mm-hmm. Do you have any controversial takes about stablecoins?
Oh, God. Do I have any non-controversial?
All right. Give me some.
Let's think. I mean, give me a prompt with some...
I mean, like, what's something that you've said recently about stablecoins that someone was like, I don't agree with you on that?
I don't agree with you on that. I mean...
Surely not everyone's agreeing with you.
That is kind of the alarming thing about where we are in the cycle. Like,
I mean, yeah.
Everyone... So this is... I noticed this the other day. I think my controversial take is that something I'm nervous about is how friendly the media is towards this sector.
Yeah.
Like every other sector of crypto, they hate it. They hate Polymarket. They hate Kalshi. Mm-hmm. They hate... any sort of new crypto development that's happening. They think it's all a scam, but stablecoins, they love it.
Yeah.
So my controversial take is I'm nervous at how friendly the media is.
Why do you think they love it?
I don't know. It makes me feel like, are we doing something
wrong? You got to
wrong?
ask a reporter next time.
I've always felt like you kind of need the media to be against you. Otherwise, you're doing something wrong.
As a former reporter, I wish that was not true. I think maybe to answer your question, as if I were covering the industry still today, I would see stablecoins as like just, it's not a threat the way something volatile would be perceived. Do you think that's fair? And so maybe it's like something that could improve financial systems, but it's not something that I'm concerned is going to have like... But then I think about like the algorithmic stablecoins. But I think that's a separate category.
Those aren't stablecoins. Those are Ponzi. Those are tokenized Ponzi.
Okay, I was going to say.
That's tokenization.
That's what I was trying to say, the sentence I was trying to say, but I was struggling in the process.
Tokenization in that case is when you take Bernie Madoff and you wrap it in a token. And that's an algorithmic stablecoin.
The Bernie Madoff algorithmic stablecoin.
Exactly. No, I think my other controversial opinion would be that stablecoins are, and this is more of a crypto controversial opinion, not specific to stablecoins. I think stablecoins are what will fulfill Satoshi Nakamoto's original vision for what crypto was supposed to be, or what Bitcoin was supposed to be.
How?
Because he really wanted to tear down the commercial banks. When if you read the white paper, like he pushed a lot of animosity towards the central banks. I think he had a fundamental misunderstanding about the way money was created in the economy. And he really should have been targeting the commercial banks. They were the ones getting bailouts. They were the ones that caused a lot of the problems. Yeah. Mm-hmm. And I think stablecoins are the way that gets facilitated.
That's so interesting. But I guess why didn't he create a stablecoin then? Because initially Bitcoin was, interpreted as like a peer-to-peer transfer mechanism.
I love Bitcoin. Bitcoin's my favorite crypto still.
Yeah.
I think Bitcoin is a great replacement for gold. And central banks moved off the gold standard a long time ago. As long as the US dollar is king, stablecoins are the only way to disintermediate commercial banks. Now, I think Satoshi may have had a much bigger vision, which is awesome and will play out over the next century, unfortunately, where the US dollar itself becomes less systemically important. Mm-hmm. And things like gold and Bitcoin start to replace dollar reserve assets on central bank balance sheets. But in the short term, like the way that we start to disintermediate these commercial banks from our daily lives, that's stablecoins. And we finally found a way that the government likes it, which is where we collateralize them with government debt.
So, it makes them happy, right? Yeah.
Everyone's happy.
Everyone's happy. And that's why the reporters are happy with you, because the government is happy. Yeah, there we go. How do stablecoins and tokenization kind of go hand in hand?
I mean, a stablecoin is really a tokenized dollar. So they are a form of tokenization. Mm-hmm. They're not a tokenized bank deposit. I think that is a big misunderstanding that most of the market has. Like, I think people think, oh, if I put $1 in JP Morgan can issue a JPM coin and it'll be just as good as $1. No, it'll be JP Morgan deposits, and your counterparty risk is still there. Whereas if you go with a Genius Act style stablecoin, your counterparty risk is really just the U.S. government, and whatever intermediary plumbing there is in the middle there. But like, the financial risk is T-bills.
Okay. I also saw the recent governance vote that allowed BUIDL, which is BlackRock's fund, to be eligible collateral for stablecoins built on M0. Maybe for some people that was a bunch of gibberish. So can you break it down for me? What does that really mean in practice?
Yeah. So the issuers in our network, they have two ways to collateralize our stablecoins. One is by having a treasury function and managing their own group of funds or portfolio of T-bills to make sure that the portfolio is constantly efficient. But the other way to do it is to use a tokenized version of those funds. And I would say the big difference there in terms of utility to the issuer is that the legacy system is once again completely siloed within the traditional banking sector. So you need banking hours, you need wire transfers to be flowing. The tokenized funds generally will allow creation and redemption in another stablecoin like USDC. And that's what a lot of the user funds are coming in as. So they're able to do more instantaneous creations and redemptions, and also on-chain management of the collateral in order to provide a better onboarding experience.
Have you guys done this before?
Yeah, we already integrated Superstate, and they hold, I think, something like $300 million of assets in our system. So we've had a good experience with tokenization, and I think that the BUIDL will add a nice complement to that asset. Okay.
And did that initiative come from BlackRock itself or Securitize?
No, it comes from our issuers. So our issuers look out in the market, and they need to be competitive to optimize their portfolios. And they say, listen, we'd like to have the broadest universe of products available to us. So when they tell us, we look into it, we make sure the risk is acceptable, and then we make a proposal to add it to the system.
That's so interesting. And who votes on the governance proposals?
So our token holders, technically.
Yeah. Okay. Checks out. All right. I didn't know you guys had a token.
It's not a public token. So this is where we're kind of in this aspect.
Yeah.
Like, we don't have any tokens circulating on the market today.
Yeah.
We do have two governance tokens. One is called Zero, and that's much more of a passive asset. Then we have a token called Power, and that's the active governance token of our system. It's entirely held by the founders, our cap table, and our employees.
Okay.
So it's really it's you could think of it like the M0 board, and employees are voting on it.
Yeah. Okay. That makes sense. Do you see more of these kind of rolling out in the coming year?
The tokenized funds?
Yeah.
There's a lot of them already. I don't think more will roll out because there's so much competition in the space already, but there's already like 6 or 7 of them that are viciously competing for market share.
No, like on M0.
Oh yeah, I mean we have no opposition to adding these things. Again, it's not up to us what gets allocated to them. So even though we've added it, we don't choose the allocations that go to it. That's entirely up to the issuers in the network.
Okay, that makes sense. And when it kind of comes to leveraging these tokenized treasuries, what other ways do you kind of see opportunities on this front with stablecoins?
So specifically for the collateral, the T-bills that are backing them? Or...
I think so, yeah.
So I think the reason that we like tokenization in this aspect, and we'll see how much it takes off. Again, we're kind of agnostic there. But one of the nice things is that they're much more programmable. So you could say that if you need to transfer funds between two issuers, now you don't have to go and call a broker and have them do a complicated account transfer behind the scenes. It's much more like a bearer asset where, like, for instance, if they're holding Superstate, as long as they're both whitelisted by Superstate, they can freely send the token to each other. So if we, like, for instance, we have 2 issuers in our network, Bridge and MoonPay. If Bridge wants to send a T-bill to MoonPay, it's a lot easier to do that with a token on Ethereum than it is to do that with a real T-bill.
Okay, that makes sense. Also, your co-founder, Luca Prosperi, gave a talk recently where he said money should be seen as a network, and how today's current system concentrates value and risk, and that structure kind of should be redesigned instead of rebuilding a Wall Street on chain. I hope that was clear enough. But what is kind of your take on this as well? Do you view it similarly, or do you find maybe that it could be that we could just rebuild Wall Street on chain?
It's a loaded question because what is Wall Street, right? Like, are we talking about
downtown? Yeah, literally. Yeah.
I think what Luke is trying to say is that there's a lot of embedded counterparty risk and a lot of choices being made on behalf of consumers that they may not want to make. I think what these systems do is they make everything much more transparent. They offer a much narrower experience for the user. Like, again, compare stablecoins to a bank deposit. A stablecoin is just a token backed by T-bills, basically, and cash equivalents. A bank deposit is backed by mortgages. It's backed by business loans. It has a lot of complexity behind the scenes, and the alignment of risk in those entities is not always in favor of the consumer. So this is one thing I loved about Genius. Like, they put bankruptcy protections right at the top of the list of the Genius Act. So if you're holding a Genius stablecoin, and this doesn't exist yet, but when it does, if you're holding a Genius stablecoin and the issuer goes bankrupt, you have priority over the claims. Whereas if you're holding a bank deposit, you only have priority up to the FDIC insurance limit. After that, good luck.
Like 250, 500, something like that typically, right?
I think it's 500 now. But the problem is that the incentives at those institutions are not aligned with the consumer. At a stablecoin, Genius has very clearly aligned the issuer with the consumer. They really can't cheat. At a bank, because of the artificial monopoly they have over creating money, they're going to let you hold a deposit with them. They're going to pay you 0% interest on it. They're going to take tons of risk. And if something goes wrong, they're going to get bailed out by the Fed. So I think...
And then what about us?
You better hope you're a part of the bailout.
Okay, but then under Genius, then how much is insured? Is there a limit to it?
There's no, this is like where I think it's like kind of a tricky marketing problem because there's no insurance per se.
Yeah.
But I don't know why you need insurance if you're holding government assets. Like government, if the government is bankrupt, FDIC is also bankrupt. So.
And then we got a bigger problem on our hands. Yeah. How do you kind of see the monetary layer then evolving with stablecoins, like in the near term?
I think what you're going to see is, so we've already kind of seen this transition happening post Dodd-Frank where the banks are, like I said, outsourcing credit creation. So they've already outsourced half of their business. The other half is deposits. That's also, I think, going to start getting outsourced to stablecoins. So what you'll see in the future are big, very simple applications that kind of replace what used to be the cash in your pocket. Think 50 years back, like we've lost something here. You used to have $1 in your pocket.
Meant something.
It was real.
I could buy a Big Mac with that at one point. Yeah.
That dollar had very unique properties that bank deposits do not have. So in the process of digitizing money, you've now taken on a lot of risk for really no reward as a consumer. Whereas this is a way to give you the consumer back the risk profile of a physical dollar without the frustration of dealing with physical money, but in still digital form.
And so, because when you talk about this, it makes me kind of feel like, okay, we'll just phase it out and move forward with this like new technology opposed to like the physical dollar.
Oh yeah, I guess I didn't actually answer your questions.
That's so, right. I got sidetracked as well.
Like what I was saying is like you'll see consumers save money in stablecoins, and they'll use that as like their very safe savings mechanism, but it won't produce yield for them. If they want yield, they're going to have to take risk. But that's what banks are doing on their behalf already. So really what it means to me is that banks in the future will turn back into the risk pricing machines that they started as, where they'll have to pay them a greater than inflation rate on that deposit.
Yeah.
So if you're looking at like what your savings might look like in the future, I think you're going to keep maybe 10 to 20% of your liquid savings in stablecoins in apps that offer you like a variety of financial services. And those apps will be run by probably major fintech brands and backed through technology like M0 that routes you to issuers. And then on the other side, for the rest of the 80% of your savings, it'll be taking risk. It'll be productive in the economy, but you'll actually be getting paid for taking that risk.
Through yield or something.
Yes.
Better yield than what the banks are giving currently.
Because the banks, once they start losing this free money deposit base that they have, they will be forced to pay you a yield again. They used to pay you a yield. They stopped.
Did they? When? It must have been a child.
Back when we
or
had...
dead. I don't know. I wasn't alive yet.
No, yeah, it was. So it was back when physical cash was the predominant way of transacting the economy. People kept 10 to 20% of their savings in physical cash, or in some sort of
mattress,
very low risk, and then the rest of it was in banks. And if banks wanted to compete with cash, they had to offer a yield.
Oh, wow.
But now they don't have to compete with cash anymore, so they stopped paying you.
When was that? Do you know? Like
I think the 90s.
All right, yeah.
It also coincided with when inflation kind of tapered off and like it wasn't so devastating to not make a yield on your money anymore.
So this would kind of squeeze banks.
I think that's really the goal of stablecoins. It's to make banks better. Because banks have really stagnated in terms of technology and innovation because they don't have to compete. Now that basically stablecoins are introducing another cash approximate to the economy, where when banks had to compete with cash, they were forced to be a lot more efficient and a lot more competitive. We are putting that competitive pressure back into the market with stablecoins.
Yeah. So it doesn't go with the question I was asking you at the beginning when I said, do banks think you're crazy? It's more so like, do banks maybe feel pressure or threatened by
I think they do now.
Yeah.
I mean, that's why they're fighting hard back on Genius and stuff. But
but Genius passed.
If you look at anything in the history of the economy, like the better product always finds a way to win. No matter what the current situation looks like, once people get a taste of a good product, they want more of it. And stablecoins are a good product.
Yeah. Do you think the name stablecoins will stay? Or it'll become something digital dollar?
This is kind of funny. So when we started M0, we tried calling them crypto dollars.
Oh, man.
We tried making like an industry-wide push. We are going to rename this thing to crypto dollars.
Yeah.
Because we were thinking they're very similar to euro dollars. I don't know if your audience is familiar with that market, but I'm not talking about like the euro currency. I'm talking about dollars that are sitting in foreign banks.
Okay.
They're kind of like a derivative claim on dollars. And we're like, so these should be called crypto dollars because they're the same thing on the blockchain.
Yes,
yeah, that didn't work.
No, it sounds like a very crypto bro thing. Yeah. So stablecoins, do you think that'll stick?
I actually think it'll all fade into the background. Maybe that'll be industry jargon. If we're selling a customer, we'll call it a stablecoin, but the end user is just going to see a US dollar balance. You like when you go to your Venmo app, like you don't know who Venmo's banking partners are. You don't care that you're holding JPM dollar. Like you just see a Venmo balance.
So it'll just look like a dollar then.
It is a dollar.
Well, it is, yes, but and then it says like, the ticker at the front or something.
It's a tougher question you think. Like, what is a dollar? It's not a bank deposit.
What is a dollar? Yeah.
Like when you go to the bank and you deposit into JP Morgan, like that's not a dollar. It's
just a number on the screen that I'm transferring.
That is a deposit certificate with JP Morgan. If this was pre-digitization, they would have gave you a piece of paper that says, we owe you this much money. You're lending your money to JP Morgan. They took your dollars.
Yeah.
So like that, we use bank deposits as dollars today, but they really are very poor dollar approximates.
Yeah. Do you have a dollar on you right now? Do you carry cash anymore?
I couldn't even tell you. I might.
I'm not trying to get robbed.
I haven't opened the wallet in so long. I wouldn't even know.
I carry like the occasional $20 or like $5 bill, but typically no, I don't have any form of cash on me.
I often find that whenever I'm at a place that only takes cash, I have maybe $2 to $3 less than I need. So
if I go to a cash only place, it's because I know they're cash only and I show up prepared.
No,
but I know what you're saying.
I'm not that smart.
Yeah. Well, I guess because like a question on that front is like, should we operate in a cashless world?
We do.
I know. But like, what's the negative to that?
Well,
there's a ton of positives,
the negative up until now is that you're forced to store your money in higher risk bank deposits without getting compensated for it.
Yeah.
But I think that's a very philosophical point that's lost on the average person.
But what about kids? Like, we give them credit cards? When I was a kid, my parents would just give me like $20 or something.
But this was a transitionary period, right?
Yeah.
Like credit cards themselves don't even really exist anymore. Now you have phones. And you have a credit card that you've uploaded to the phone.
Yeah.
So our kids, again, are just going to see a number on a screen.
Yeah.
And that's going to be their money.
Yeah. You better hope you could lock that account. I don't trust kids. I remember my sister. She was bad. What do you think has been wrong up until this point on the front of stablecoins? Like, it seems very optimistic, but what is the work that you think still needs to be done then?
So up until, the last couple of years, kind of, this is basically what M0 pioneered. There were these vertically integrated issuers. So you have Tether, you have Circle. There was a couple other competitors in the mix there, but basically the two juggernauts, right? These, like, we've now realized that stablecoins are going to play such a systemic role in the economy that it would be crazy to let one entity have all of that power. Right? Like, that's like basically you're deputizing them as the sole bank of the whole country then.
For stablecoins, you're saying?
For what becomes cash in the economy. Like, if you follow the line there, like, stablecoins will become what cash used to be. And at that point, that will be a very significant chunk of the U.S. money supply. You cannot have one entity controlling 20% of the U.S. money supply.
And currently.
And that's exactly where it's been trending.
Yeah.
Because then that entity very naturally becomes too big to fail. And you're back in a situation where you are utterly reliant on regulators, not transparency, not consumer protections and not even market forces to make sure that that entity doesn't blow up.
Yeah.
And the incentives become this is what Luca was saying. The incentives become entirely misaligned once again. So I think it's just nonsensical to think that a single issuer can capture this entire market. That's why we actually think that the power lies with the distributors. But the distributors don't want to have regulated issuance. That's why we created a layer that connects those two people. So that's what I think is wrong with it. That's why we're trying to fix it.
Yeah. I mean, like Tether and USDT and USDC do have a lot of the market share.
The vast majority, but I don't think that'll last.
Yeah.
That's just because the traditional companies have not yet fully endorsed this market, but now that Genius passed, they are. And as they come in, like I can tell you firsthand, they're not going to use USDC or USDT. Why would they give all of their economics?
They're going to make their own.
Yes.
Yeah.
Now, Circle's coming in, they're going to try to compete with us. They're going to do a sort of third-party issuance thing, but I still think that these businesses will be very wary of giving all of this power to one entity. They're going to want to see a more open framework.
What about on the consumer side, though? Because the average consumer isn't going to go create their own stablecoin. They're just going to go use like USDT or USDC, right? So maybe that's how it still holds a vast majority of that market share.
Is not going to have any consumer protections in the U.S. They're issuing a completely different asset for that called USAT.
Yeah.
The offshore version is backed by like Bitcoin and gold and stuff, right?
Right.
It's very solvent. Like I'm not trying to say that Tether is going to go bankrupt anytime soon, but it's not regulated in any way, right? USDC will gradually become compliant with Genius, and therefore I think the consumers will be just fine holding USDC. The question isn't so much from the consumer's perspective, like, why hold this asset? Because again, the consumer is not going to make a conscious choice. The consumer, when they go to their apps that they interact with the financial world on, is not going to say, buy USDC. That's a remnant of a past technology. They're going to say, here's your dollar balance.
Yeah.
And the company's the
That's
one
what I
who
was
made
getting
that
at
decision.
before. Yeah. Like, would it say the USDC, go get your stable coin, or would it just say $1?
Tickers will be dead in 2 years.
Damn. But then on the back end, how do you is it a fight with like B2B, like to get yours chosen as the issued stable coin?
No, it's a conversation with the distributor. So when I say distributor, I mean the app. Like that's the entity that's taking on the reputational risk of working with your business. They have to feel confident that the service you're giving them is good enough for their customers.
You see this as like a near-term, or not solution, but near-term result that's going to happen.
This is our whole pipeline.
Yeah.
This is what we do.
The M0 mission.
Yep.
Yes. Got it. Okay. It's all coming together now. The pieces are coming together. How else do you kind of see institutional involvement then kind of evolving in 2026 compared to what we saw this year?
I think every financial institution will find a way to get into this market. Just because, like I said, it's going to be such a large portion of the money supply, they can't afford to not get on the train. So you'll see the ratings agencies, they rated Tether. They're going to start rating all of the stable coins. The regulators are here. We know that. You're going to start seeing banks issue stable coins to try and remain competitive. Name a financial institution, they will be there.
They will be there. Do you think the rating institutions are accurate though, or like they know what they're rating properly? Like, have you sat down with companies like S&P and others that do this?
I think they do a good job, but I don't know if they always present information that's useful to retail consumers because that's not their market.
Yeah.
Like they're trying to express risk to their institutional clients, and institutional clients just have a very different set of needs than a retail client.
Okay. I know you said stablecoins are a form of tokenized assets, so just bear with me on this question. But what will be bigger, you think, in the long term, stablecoins or tokenization?
It's the same thing.
No, come on. There's like tokenized assets of like RWAs, and then there's like stable coins. That's what I'm separating the two now.
Volatile assets.
Yeah, sure. If you think they're volatile. Yeah.
I think ultimately the market value of the tokenized volatile assets should exceed the value of stable coins.
Yeah.
Because if the entire economy is coming on chain, like just by definition, these assets are going to have a bigger market cap than the money supply.
Yeah. Okay. So another question I have on that front then is I think like the total number of stablecoin holders right now is, I want to say like 200. Yeah. Okay. 206 million. Do you think that's because of the distribution problem right now? And then once that's kind of resolved, it will hit
I think that's because
billions.
All of those people are conscious stablecoin holders.
Yes.
They have made a conscious decision
to
go purchase stablecoin.
Yes.
That's probably reaching, a linear growth rate that will not go very fast if that continues to be the way it happens. But that's not going to be how it happens. You're going to go on one of your apps. They are going to reroute your balance to a stablecoin instead of a bank. You're going to have no idea, but that's going to add 200 million customers in one day.
Yeah. When will that happen?
I think this year.
Really?
They're going to start seeing it 2026 and 2027 will be the 2 big years that'll be make or break for the industry.
Damn. Okay. Aside from M0 world domination, what else would you like to see happen ultimately?
In the world?
Yeah. Or I guess like in this industry on the front of stablecoins, tokenization, etc.
Let's think. I would like to see some other crypto native applications start to innovate. Like I feel like we've really the industry's been a bit depressed on use cases. Like that's why I love USDAI. That's why I love to talk about them, because they do have that like really interesting connection between the crypto world and the legacy world. But we need to find more ways to weave crypto architecture into legacy businesses. Otherwise, we've just built this for a vacuum, right? Like we have enough speculative use cases. Let's start to get like the real stuff going.
Yeah. And do you find that those who are building these use cases can integrate with M0 and kind of like?
Well, I find that basically every use case requires a stablecoin. And if it requires
everything requires a form of money and everything.
Yeah, well, or it requires something that's stable versus dollars. And we don't even really see a lot of international demand for other currencies. Like it's really just all dollars.
Yeah, so no like euro, yen, etc. No.
Those, what I found though, and I even found this more so at Maker than with M0. People in other countries they like dollars. You're in Europe, like your bills are denominated in euros. You don't mind holding dollars. It's not so volatile versus the dollar that it'll make a difference for you. So a lot of them, if they're forced to choose between holding USDC that has tons of liquidity or holding like Euro coin that has no liquidity, they're going to go with USDC because the liquidity is more valuable to them than the volatility.
Do you think about the relationship in emerging economies differently?
Well, stablecoins are dollarizing those economies.
Yeah.
I mean, this is one of my grand theories. So if you look at like the history of monetary expansion of the United States, we started out with our domestic dollar. The British pound was the international currency. That flips after World War II. Bretton Woods comes in. We start using dollars as reserves, and this was the first connection point where now foreign central banks are holding dollars. Then we start, the petrodollar comes around. We start denominating international trade in dollars. Everything there just to service our ever-growing deficits. I think stablecoins are the end game here. So this is how we take it to the next level. Like instead of just dealing with the periphery of other countries where we're maybe just talking to their central bank or just talking to their major trading houses, this is how you get like the average person in a foreign country using dollars instead of their local currency. It gives the dollar another 50 years to run as many deficits as we want.
Yeah. What's the one thing you think that could actually kind of prevent this all from happening?
I don't think there's one thing. There's a lot of things that can...
Really? Okay.
I mean, they're all outlier events, but like, any sort of serious geopolitical conflict, I mean, who knows what happens in that environment? Yields go to zero. It slows adoption. Companies are not really focused on innovation, or maybe a major recession stops people from innovating, because this is still a very innovative industry, right? Like you need people to invest in tech and R&D to get it done. Yeah. The other thing would be adverse regulation. Let's say there's a regime change in Washington, they come back and they just want to bring back the Biden years. That will not be friendly to crypto, especially if they get congressional control. So there's a lot that could derail it. But again, I think the long-term trend will always be towards adopting the technology because it is such a better product. So there might be bumps in the road, but long-term, this thing is happening.
Yeah, I'm a tech optimist. I was just, had to ask.
Me too.
Yeah, fair enough. Okay. Last thing, aside from everything that we talked about, what else are you watching that you think others should pay attention to?
In crypto.
Sure. Or wherever you want to go. It's the holiday season. If you want something there.
I mean,
You're like, no, back to crypto. Yeah.
No, I mean, I guess like I like to think of myself as multidimensional.
Sure.
So I studied economics in school. I have like a very strong interest in economics. I think there's something very unique going on in the U.S. economy right now that I'm still trying to put my finger on, but I don't think it's healthy, basically. So I think what I'm paying attention to besides crypto is I think there's something very strange going on in the economy with asset prices, with consumption patterns. I would like to see or actually, I'm kind of nervous to see how this all plays out.
Yeah.
Because we've driven the asset price inflation to the point where I think it's actually financing people's incomes, and we've yet to see how that plays out in politics.
Yeah. Are there any forms of like sources of truth that you track on this front?
I think the data is fine. It's just, what do we do about the data? I think the average person is starting to realize that like there's something broken about the system where asset prices continually go up because of multiple inflation and not because of earnings growth. And eventually that's going to stop and something's going to break. And I think the political fallout is going to be the hardest part.
Yeah. How do you think about hedging against that?
Bitcoin?
There we go. There's your back to crypto. Yeah. Pull it back in. All right. Fair enough. Last thing, Greg, can you leave us with a piece of advice, something that you've carried with you throughout your time in this space?
Remain humble.
Yeah.
Because you will get humbled continuously.
100%. Yeah. Amazing. Well, thank you so much for coming on today.
Thanks for having me.